Mandy? Good afternoon or good morning to some of you. It's a beautiful Friday afternoon here in New England, and we're going to be talking about two topics today. Um, in case you don't know who I am, my name is Tyler Olson. I'm a financial planner, and thankfully, I am not doing all the teaching today. I get to share that responsibility. Um, Michael Relvis, a certified financial planner, um, he's going to be talking about the things that interns, residents need to know about disability insurance and guaranteed standard issue policies, or GSI, and how it relates to your decisions. We're going to be talking about that first for 30 minutes. At that point, Michael will go into a breakout room where any of you who have specific questions about disability insurance can go in the breakout room of your own volition and ask him questions if you wish. We also have all of your questions that you asked in the Google form, and I really appreciate you doing that. That was great because that gave me and the third teacher, Steiny, Dr. Jeff Steiner. We're going to be talking about student loans, and we can also answer some of your questions about disability insurance too, as we can. So we'll be talking about disability insurance first, and then we're going to be talking about student loans for the remaining 90 minutes, because obviously that's like the big topic that many of you are trying to sort out. All right. If you have any questions that you want to share, you're welcome to put them in the chat. Otherwise, just sit back and enjoy, listen, and thank you for investing the time today. We'll try to do our best to make it worthwhile for you. To get us started, Michael Relvis, he's going to be talking to us about the important decisions surrounding disability insurance and guaranteed standard issue policies, how it is relevant to you. So, Michael, please go ahead.
Great. Thanks, Tyler. I appreciate it. So I'm going to start sharing my screen here. All right. Can everybody see that? All right. Thanks, Tyler. So like Tyler said and mentioned, my name is Michael Relvis. I'm a certified financial planner professional. I've been doing this for now just under 20 years. I'm a University of Maryland undergrad graduate. I'm a Terrapin. I accidentally fell into this career path right out of undergrad. My truthful intention was to do investment management and financial planning for people, and within a year, I realized that I actually really liked this. So not something that everybody can say, but yeah, just kind of accidentally walked into this. So like I mentioned, I've now been doing this for almost 20 years. I specifically work with disability insurance and term life insurance, exclusively with physicians. It's an interesting market. There's a lot of details. But I think those details can be simplified for anybody who takes sort of an educational approach to, explaining it to you. So today we're going to talk about disability insurance a bit. A big topic, obviously, everybody sort of asks about it. You've probably heard about it. Other, soon to be co-residents, attendings. I think it's really important to understand the root of disability insurance and why it's actually needed from a financial planning perspective. More often than not, we get phone calls from younger residents who are basically saying, look, I've been told I need to get this, it's cheaper. Honestly, we even get it from graduating residents and fellows who are like, look, I was told I need this. I was told I need to get it before I leave residency because it's cheaper. Is that true? What's really the truth from it? And I think it's important to understand that there are some financial benefits to getting it at younger ages and sooner. But the real reason that disability insurance is important is because it provides income protection. And physicians are sort of in an interesting career path where it's very delayed. You've decided to go down a path with a lot of prerequisites, obviously, between medical school, residency, fellowship. you might have invested a decade by the time that you're actually in attending. And so we want to protect that investment all along the way. And that's really why it's important to get disability insurance as a resident rather than just waiting until you're an attending. Every year that you move along throughout this career path is one more year that you've invested with really no reassurance or no guarantee that you're ever going to get to that final, end of the tunnel where you're actually earning at an attending level. So disability insurance is important. There are a lot of benefits to it. There's a lot of perks of getting it younger and earlier. But again, I think it's really important to understand the root is you need this because if something, God forbid, happens to you and you're no longer able to work and continue down this career path, it would just have been, an awful big waste to have spent the amount of time that you've already spent in it, let alone as you're a PGY 3 or 4 or, a fellow. There are some perks of applying during residency when you're younger. Generally, good health is important. I think it really comes down to more so the ability to buy coverage. Traditionally, disability insurance is applied for and medically underwritten, which means you have to be healthy in order to qualify for it, in order to actually get a policy. And so when we're younger, we're usually healthier. It's usually a little bit easier to get it. But it really does come down to, the benefit there is we just want you to be able to get coverage. So however we can do that the easiest way possible, the better. And earlier in residency is usually a little bit easier. Lower pricing. It is often a little less costly to get this when you're younger and when you're a resident. That's due to you being younger. Disability insurance is partially priced based on age. So the younger you are, the less expensive it's going to be. But also there are some discounts that you can secure as residents. And those discounts do carry over, even as an attending, you might be able to access them. They're just much more plentiful during residency and during fellowship. Pretty much any resident and fellow can get a policy with a discount, whereas during attendinghood, that's not necessarily the case. Simpler underwriting is a key perk. One of the big things we're going to talk about today is GSI, or guaranteed standard issue. I won't jump quite into that yet, but even just the process of buying it as a resident, one component that you would normally have to go through is what's referenced as or known as financial underwriting, essentially providing a copy of a W-2, a pay stub, or an employment agreement, something like that. It helps justify and verify your income. And as a resident, we don't need to do that. The insurance companies offer promotional amounts that you can just buy generically, regardless of what your income is, regardless of what group disability insurance you have. It really doesn't matter. You can get a specific amount as a resident automatically. So there are some benefits to getting it earlier on and as a resident. I think one of the big things, though, just to reiterate, you need this because of the income protection. That's really the primary benefit of getting it sooner. Applying for disability insurance the traditional route. So thankfully, this is not actually even as bad as it once was. Pre-COVID, in order to apply for disability insurance, you would have to actually meet with a nurse, a person in person, believe it or not. You would do a blood draw, a urine sample. They would check your basic measurements, your vitals. And all of that would go into the equation of what the insurance company is willing to offer you, basically an assessment of the risk that you present, right? How likely is it that you are to become disabled at some point throughout your career? The one good thing, at least in the insurance industry, that came out of COVID is that they no longer do that. Now, as a resident or a fellow, if you're applying for coverage, you actually don't have to do any type of in-person exam, and that goes with all of the companies, or the majority of the companies at least, that are major players in this marketplace. Um, Nonetheless, when you are going through traditional medical underwriting, it's a process. You're completing an application. Along with that, you're completing a medical history questionnaire and providing essentially a HIPAA release authorization to the insurance company so that they have the right to review all of this information. Since COVID, there has been a huge progression in what the insurance companies have access to behind the scenes, basically accessing databases that they pay for and subscribe to have access to. Things like running pharmaceutical checks so they can check any medication you've been prescribed in the last few years, even looking at major medical claims, anything that's been processed through a health insurance policy. They might not see exactly what it was, but they'll see a code. And so if you forgot to disclose something on your medical history questionnaire, sometimes that will recapture that information and the insurance company can come back and say, look, you didn't disclose that you had this chest x-ray, but we see that you did. Can you give us the information on it? and let's figure out what was going on. Insurance companies do have the ability to order medical records from your actual physicians, whether it be counselors, therapists, primary care doctors, specialists, whatever it is. They do have the ability to go order those records and review them as well. One of the biggest downsides to traditional medical underwriting is we go into this expecting, okay, we're going to apply, we're going to have to go through this work, and then we're going to get a policy. But the reality is there's no actual guarantee when going through the traditional underwriting process that you will get a policy at the end of it. In fact, there's a risk that the insurance company is going to decline you. They may come back and charge you a higher premium than what you expected. They could limit the benefit period, limit the riders or the features that you're including on the policy. And probably the most common thing that we see is that they'll come back, they'll offer you a policy, but it will exclude pre-existing conditions that you had in your medical history. Just to give you an example of what that looks like, if you, for example, had some, I don't know, some neck pain in the last 6 months, and you went and saw a specialist, or you saw a chiropractor, or you did some physical therapy, there's a pretty good chance that the insurance company is going to want to exclude your C-spine. And so what that means is they're going to offer you a policy that says, we'll cover you, but we're not going to cover you if it's related to the C-spine. Nobody really wants a policy with a C-spine exclusion, of course. It always comes back to the back, right? And so anyway, that is one of the biggest downsides to a traditionally underwritten application is that we might come back at the end of all of this and not even get the policy that we thought we were going to get. As far as time frame, the traditional underwriting process is somewhere between 3 and 6 weeks. That is an average. Not everybody is going to have an application take that long to process. If you are one of the individuals who hasn't seen a doctor in the last 10 years, legitimately, there's no, medical history there. There's nothing that the insurance company can review. So it should be a little bit faster. Someone who has seen several doctors in the last, 5 to 10 years, unfortunately, that could take a little bit longer. And the reason for the delay is we're kind of at the mercy of how long that medical practice or facility is going to take to provide those medical records. If the insurance company orders them, they're waiting for them to be copied over to them, and some of those still take quite a while. GSI is kind of the topic that we're going to be talking about mostly. I promise I'm getting into it, and I'll start getting into it here. But the process of applying under a GSI offer is much easier, does not involve all of this medical history information and the insurance companies evaluating your risk. So the process of applying for GSI, quite literally, as long as you are an eligible applicant, you submit an application. Within a day or two, maybe 5 at most, you are you are approved and sent an approved and issued policy, and that's pretty much it. So you can go to the beach or to adventure, whatever it is that you want to do, but basically get back to what you were doing, and it's not quite as timely of a process. So GSI has really simplified the process of securing disability insurance in a very big way, actually. So what is guaranteed standard issue? What is GSI? There are a lot of details on this, so I don't want to downplay it too much, but the honest truth is it's actually very simple. This is the same exact thing as buying an individual disability insurance policy, just like you've been recommended to do before you heard about GSI and before GSIs really existed in such a big way as they do today. You're buying a normal individual disability insurance policy. It still includes all of the same policy features, riders, all of that. It's just a simplified process. So instead of completing an application that involves a medical history questionnaire and then also gives the insurance company authorization to review a bunch of your medical information, this is a very simple application. It asks for things like your name, your date of birth, your social, your home address, work-related information. There are some general questions that are risk-related. Do you like to rock climb? Do you skydive? Do you scuba dive? Have you, had several DUIs and DWIs in the last few years? Do you travel? But other than that, it's really not going into much detail, and it's certainly not including anything medical history related. That's really what GSI is just more the process of buying an individual disability insurance policy and it being in this simplified manner where you don't have to share all that information. That's what's allowing it to become a lot easier and a lot faster or more streamlined of a process. One of the greatest things about GSI is that if again you are eligible, it's limiting your exposure and the risk of you being denied or offered coverage that has modifications like exclusions or limited benefits or anything like that. The advantages of a GSI offer. So I've already talked about some of them, but hopefully this will clarify any, uncertainties that people have, maybe any myths that people have heard. It is a faster and easier application process. That's, not really refutable. The policy that you're getting is still going to include the exact same terms that you would normally apply for. So, an own occupation definition of total disability, making sure that the policy includes great partial disability benefits. I'm sure many of you, if you've looked into this already, have heard of benefit increase options. This is a feature that would allow you to increase your coverage throughout your career as an attending. And the best part of it is it allows you to do that without having to disclose updated medical information. All of those things, cost of living adjustment riders. If you want it, you can even include catastrophic disability riders on your policy. Quite literally, you're given access to all of the primary features that we normally recommend and that people are normally looking for anyway, without restrictions. So in that regard, it's actually great and not really limiting you in any way. Pricing. So pricing for GSI options is actually very comparable to the pricing for non-GSI within that same company. So I say it that way because there is some talk out there, I've seen it where people say, oh, well, GSI is more expensive. And that's not actually true. If you were to look at a GSI policy offered by Guardian and compare it to a non-GSI policy offered by Guardian, for example, you'll see that the pricing is the exact same. It's actually not any different at all. Even with organizations like Emeritus, which is another company that is currently offering GSI, the pricing is slightly different, but it's going to be by, a tiny amount, like literally $1 or two perhaps. It's very close. The GSI offer still includes the same discounts or very comparable discounts. So one great thing about GSI is that you're not being penalized for going with GSI. I think that concept comes from perhaps years ago, where some of the GSI options that were available limited you to securing a policy that was based on unisex rates. Unisex rates were great for women, so consider it this way. The cost of disability insurance is a lot higher for women than it is for men. And unisex rates were basically the middle grounds, right? So halfway between female rates and male rates. So it was a great thing for women, not such a great thing for men. That really doesn't exist anymore, with the exception of a couple of states and a couple of GME programs still left within the country. But the vast majority of these GSI offers now are not based on unisex rates, and so you're actually getting the exact same or a very, very close cost, whether you go GSI or not. You're not being penalized by going GSI, thankfully. Just because you're applying with a GSI offer doesn't mean that anything's going to change. As far as portability, keeping the policy beyond residency and fellowship, all of that still applies. That's one of the big benefits of buying a policy now, is that you get to keep it with you throughout your career, and that's no different with GSI. Secured insurability through benefit increase riders. So the final bullet point here. One of the advantages of buying a policy during residency is that by including these options, these features that allow you to increase your coverage later on throughout your career without having to disclose updated medical information, the beauty of that is that it's helping you guarantee your insurability, right? So we talked, or I mentioned it a little bit earlier. We really just want to focus on making sure we can get you coverage, whether it's because you're in really great health and you can qualify normally, or whether you have access to a GSI that you take advantage of. The goal is to get you coverage, and having these features added to the policy is allowing you not just to get coverage now, but also to increase the benefit later on throughout your career to keep up with where your attending salary is and where your income protection should be at that time. So with GSI, we still have access to those same features, thankfully. And yeah, quite literally, we're designing a GSI policy the exact same way that we would normally design a non-GSI policy. Limitations on GSI. So the first, and I think the most important to consider, is GSI offers are only made available to individuals who have not already applied with a different insurance company and been denied coverage. In fact, with some companies, even just applying to a different carrier is enough to already disqualify you, basically, right? So if you have access to an emeritus GSI program, but you decide to apply through Guardian or Principal or whoever it is, as soon as you submit that application, you've pretty much disqualified yourself from that emeritus GSI. Not every company works that way. Some companies you would have to either be approved with modifications or be declined coverage. But the simple story here is really GSI has to be the number one option that you consider first. Applying with a different company, unfortunately, can disqualify you. And so we don't want to take that chance because, again, the priority is we want you to be able to get coverage. We want you to be able to get a good policy without exclusions, without modifications. And if it's GSI that's going to help you do that, that's a great thing, that we want to take advantage of. And we definitely don't want to mess up. So make sure that if you are going to consider getting a policy at some point, look for GSI offers. Make sure that if there's one there, you're considering that first, before going anywhere else, because you just don't want to lose that opportunity. GSI is sadly still only available to residents and fellows at certain programs, certain GME programs. It's great when there's one there. We no longer have to tell people that we can't get them coverage because of their medical history. It's a great thing. At the same time, there are still a lot of programs out there where GSI is not available. So I think, although this conversation is mostly on GSI, hopefully even for those who don't have access to a GSI program, you'll get a little bit of information that's helpful as well. But it isn't available to everyone, unfortunately, yet. We're trying to improve that. GSI plans, typically speaking, are capped at a certain amount. This is one of the downsides that we see and that some people bring up. So whereas on a normal, fully underwritten plan, assuming you qualify, you have the ability to increase that policy to much larger amounts, $20,000, $25,000, $30,000 a month as an attending. With a GSI program, you're limited to 15. That's the most that you'll be able to increase it to without having to share any medical information. Most people perceive this as a really big downside, and the reality is it's not. $15,000 of monthly benefit is the amount that would be offered to someone earning $350,000 a year if they don't have group disability insurance, which a lot of attending physicians will. If you are working for an organization that provides group disability insurance, depending on the size of that plan, 15,000 individually might be the amount offered to someone earning 450 or $500,000 of income. So the reality is, although 15,000 is a limitation within GSI offers, for most physicians, it's actually going to be irrelevant. It's not going to matter because your income might not qualify for the full 15,000 anyway. And so we're really not being restricted. For those who do believe they're going to be, a super high income earner, 600,000, 700,000, maybe seven figures as attendings, one of the ways to get around this limitation is to secure a GSI policy and then secure a secondary policy that would be through normal medical underwriting. And what that's essentially doing is guaranteeing yourself up to 15,000 without exclusions, without those modifications, right? Without the risk of being declined. And then we layer this second policy on top that would secure any additional coverage beyond the 15,000 that you qualify for. So it's not really a reason to not consider GSI. It's more so just perhaps a different strategy that we would have to take for someone who is expecting to have that sort of ultra high income earning potential. Another limitation on GSI programs is that they're all going to limit the benefit period on claims specifically related to mental health conditions and substance abuse disorders, and it limits it to 24 months. I would say the majority of the policies that we put in place these days include that limitation anyway. With that limitation, the insurance companies typically offer a discount. It's about a 10% discount. And a lot of people want to take that discount. So it's always been astonishing to me and amazing, but the majority of the physicians that we work with actually do accept policies willingly, even outside of the GSI, that include this 24-month limitation for benefits for mental health. If you are someone who doesn't have a history of being treated for anything mental health related, depression, anxiety, ADHD, anything like that, even talk therapy, and you would prefer to have full coverage for mental health, you could always do that. You could always apply for a policy and apply to have full benefits included. Those benefits would be payable until age 65. But under GSI, that limitation will be there. It's on all of them. 24 months is the maximum we can get. Um, I was, Tyler, can I get a time check real quick? Am I okay?
Yeah, you're good.
Okay, excellent. So I want to go over a couple of things that I think are really important to bring transparency to this market specifically. Um, GSI has been around for quite a while, to be honest. There have been GSI programs out there, I don't know, over 5 years, 10 years. But in the last couple of years, it's really exploded. I mean, there are now, between all the companies out there, over 200 different GSI programs, which is great. It's giving people a lot easier access to, securing disability insurance, but that's created a little bit of conflict. GSI programs are, for one, only accessible to residents at certain institutions, right? We talked about that. But secondly, not every insurance agent or broker is able to actually sell a GSI policy. And that's created a conflict because if they can't sell it to you, unfortunately, they also can't be compensated for you buying that policy, which is creating this conflict of interest where they might be actually recommending that you don't buy a GSI, even if it truly could be the better thing for you. Their livelihood depends on it, is the reality. And I don't want to just cover one side of it. I think it's only fair for us to understand both conflicts of interest. So these GSI programs are available through specific agents or brokers or a team of agents and brokers. And in order for the insurance company to continue to offer them, they're essentially looking for a certain participation rate. They want a certain number of the residents and fellows at each of these hospitals and GME programs to be securing coverage with that company, whether it's through the GSI program or not, but they're still looking for certain participation levels, right? That's how they're diversifying, spreading their risk, increasing their risk pool so that GSI makes sense for them too. And so the agent or the team of agents that has access to these GSI programs are kind of held accountable to gain that level of participation. And so there is a conflict there, right? Those agents and brokers want you to buy a policy through that company and through that GSI program. I would say that it's not necessarily a financial conflict of interest. They're not doing it because they're going to make money versus not making money. They're doing it for the success of their program. They want that program to continue. They want more people to be able to take advantage of it and for residents and fellows to benefit for years to come. And the insurance companies basically need that participation or those participation levels in order for that to happen. So there is a conflict on both sides. I think the perhaps bigger conflict and more significant one is unfortunately for agents and brokers who don't have access, they really can't, they just can't sell it to you. And so anyway, there's, this element where some agents and brokers are talking poorly about GSI, are saying, well, GSI is really only for those who are sick or who need it, but you can probably get a cheaper policy elsewhere. And to say it that way is really only half the story because a cheaper policy doesn't necessarily mean it's a better policy. It's also putting that person in a predicament where if they're going through full medical underwriting and the insurance company discovers anything, now they're getting a policy that perhaps is cheaper, but the reality is also coming with exclusions and limitations that I think most residents would happily pay $10 or $20 extra per month for to just know that they're getting a policy without those exclusions, without those limitations. So I think it's really important to understand that conflict exists there. There are agents who cannot offer GSI, and unfortunately, the story that they might tell is a little different than what it should be if there wasn't that financial conflict of interest. There's a bit of a common myth that GSI is mostly just for people who are unhealthy. It's really interesting because the disability insurance companies aren't looking at whether you are generally healthy. They're more so evaluating whether you have any pre-existing conditions. I like to explain it that way because that's really what they're doing. They're breaking it down to exactly what's gone on in your medical history. So, if you have taken medication for ADHD, I don't think anybody would claim that you're unhealthy, but you certainly do have a pre-existing condition, right? That you're being treated for, and that's fine. It's not a big deal. I'm sure you've advanced, professionally, had no problems, all of that. Yet the insurance company, if you go through a traditional medical underwriting process, is likely going to put an exclusion on that policy for anything mental health related. And unfortunately, there's a discrepancy, a pretty big one actually, between the insurance company's perspective on these pre-existing conditions and what the medical world's perspective is on these pre-existing conditions. Things like mental health conditions, musculoskeletal issues, cardiac issues are probably the biggest culprit. Somebody will have an echo done or an EKG, and they'll say, "Oh no, everything came back normal. The cardiologist said everything was fine." And then the insurance company goes and orders that report, and next thing you know, the echo wasn't completely unremarkable. There was something there, and while from a medical management perspective, it may not be that significant, right? The cardiologist might even joke and say, come see me when you're 65. It's no big deal. Just go enjoy yourself. But the reality is, these insurance companies are offering you a policy that goes out until age 65. So they're essentially trying to evaluate your risk over the next 30 years, 35 years, and that's a lot different than what a physician is looking at and saying, well, if something changes, we can always change course, right? We can find some type of treatment or a procedure or whatever it is that we need to do, but we can adjust. The insurance company doesn't get to do that. And so, unfortunately, when you're applying for disability insurance, there's a lot that physicians just don't know about this world and what the insurance companies are going to nitpick about, but they nitpick about a lot is the reality. So even things that I think most physicians would be unsuspecting as being problems can be problems. And it doesn't mean you're not going to qualify. I doubt you'd be declined, but it does mean that you might be offered a policy with an exclusion. And if we can avoid that, I really don't see any reason why we wouldn't want to. GSI being more expensive, I already addressed that. It's actually not. It might be, if you have a GSI offer through Guardian versus looking at a policy through a different company, for example, it might be more expensive. It's not because it's GSI, it's because Guardian might offer a better policy and is just going to be more expensive, whether it's GSI or not. But I think it's really important to know that that's actually not true. GSI offers are not more expensive. If your agent doesn't mention GSI, I think it's an important thing at this point to ask. There are enough programs out there, there is enough awareness. You really do want to avoid that pitfall of not asking and kind of running into trouble. A couple of action items. I'll try to get through these pretty quick here so that we can move on to the next topic. If you are interested in getting coverage, we talked a bit about the importance of it. I'm a believer in disability insurance. I've worked with people where a policy was issued and literally before they got to sign it, they were in a car accident. They rode their bike to work, fell off, and went into, emergency wrist surgery the next day. We've seen it all. It happens. You all are about to, start residency. These things can happen at any point. It's important to have at the same time. We also got to worry about budgets and figuring out what makes sense. So if you do consider this, contact a reputable insurance agent. Make sure it's someone who's been in the market for quite a while, understands this, exclusively works with physicians or predominantly works with physicians at least, and has a lot of experience. The advantage there is they're just going to know what to look for. They're going to be aware of these programs. They're going to be aware of the discounts, aware of the differences between policies. That's obviously very important. Do not share your social security number until you are ready to apply. This is a big one that we see. There are some organizations who ask you for all of this information right away up front, and what they're actually doing is submitting an application. Once you've submitted that application, you might be disqualifying yourself from a GSI offer if one's available. So don't provide anybody your social security number until you're ready to actually apply. Confirm whether you have access to GSI. And then the final tidbit would just be if you haven't already gotten quotes, if you haven't already looked at this, disability insurance can be quite expensive, especially on a resident and fellow stipend. There are a few ways that you can try to limit the impacts of the premiums. So for one, starting with a lower benefit amount than what is typically offered would be fine. Any coverage is better than not having coverage at all. And then an interesting one that we've seen a lot of actually now is considering graded premiums. So normally people buy these policies with a level premium. The premium starts out at one amount. It stays that way throughout the rest of the policy years. Graded premiums start out much lower. They continue to increase, but they also allow you to switch from the annually increasing rate to a level premium. It allows for a lot of upfront cost savings, which is obviously beneficial for residents, right? So consider your options, make sure you ask questions. Without a doubt, though, if you have access to a GSI program, make sure we don't lose access to that. Make sure we don't get disqualified. It's been hugely helpful, and just helped so many people get coverage that otherwise would not have been able to. If there are any questions, sorry, Tyler, I was looking at you.
Yep,
I know we have a breakout room that we can jump into. So if anybody has specific questions, I'm happy to address those. And yeah, that's it. That's all I got.
that was great, Michael.
Yeah.
Appreciate you delving into all those details. So yeah, there's a breakout room in this Zoom. So um, now and I'm not sure how long you're able to stay there, Michael, but just message me and let me know. But
Sounds
you
good.
can go over there, and if you have specific questions that you want to ask him, you could just pop over there. Um,
And Tyler, real quick before
yeah,
he goes over there, um, I've seen it multiple times where with disability insurance, people feel like I've got to get it, so I'm just want to get it and get it over with. And what that looks like is, oh, a classmate of mine has a brother at a big insurance company and they do disability insurance. They just started. Um, they're right out of college, and yeah, I'm just going to use that guy because it's usually a guy, and they don't understand the nuances of the disability insurance for physicians specifically. So these are one of those times you really have to go to a specialist that knows what they're doing so that you don't either one get denied um, insurance coverage or two go with the wrong get involved with the wrong type. So um, obviously choosing the right person is important. And you may get a lot of emails, cold calling emails from brokers, and you just need to make sure that you are working with somebody who knows what they're doing.
yeah, yeah, great point.
Yeah, couldn't
All
agree more.
right, well, let's see. All right. So, Michael, yeah, head on over there. Anybody who wants to ask him questions, he'll be over there. I'll update you on how long Michael's going to hang out. And we're going to talk about student loans now. So, and Steiny is going to lead the way on that. And then, after he after he goes through his series, then um, uh, that Jeff and I will both be available to one answer your pre your the Google form questions that you put in your responses, as well as any that you have today. So if there's like questions that you have today, just put them in the chat here. Um, and there's the number of us here are low enough that as long as it's not too chaotic, if you want to ask your question, I think you have the functionality to unmute yourself. That's fine with me. Just one at a time. But for to start though, Steiny, take it away. Let's talk about student loan decisions right now.
Okay, so perfect. For those of you who don't know me, I am a early retired physician, now financial planner. So I was a double boarded pediatric anesthesiologist. I'm a former program director, former director of operations for my group. So we had um, a schedule that I ran for years, and I have a lot of kind of experience with GME departments. I still do lectures on campus for medical students. And I went ahead and got the training to become a certified student loan professional. So um, that's who I am. I do financial planning. This is what I do full time now. I really enjoy the puzzles of planning with clients. Many of my clients are physicians, and so that's kind of who I am, and a little bit of background. So, professional disclosure, I'm not giving, this is for informational and educational purposes only. I'm not giving individual investment advice. Um, The first thing that I wanted to start with student loans. I mean, right now there is a lot of stress about student loans. Now you've got two prominent billionaires fighting over Twitter in a tiff. A lot of distractions, a lot of stress. And what I want to start off with is while you're a resident, don't feel like you have to fix everything. Your goal as a resident is just to tread water. That's all you got to do. You just got to make sure that your payments are affordable, make sure you have food on the table, rent is taken care of, and you have some space for mental health and for spending money on things that improve your well-being. So, what does that look like? That may look like paying somebody to do your laundry, as crazy as that sounds, to free up time, because time is your most valuable resource when you're a resident. And just realize that with student loans, as scary and stressful as they are, you're going to be able to one day be done with them. You just got to tread water right now and don't feel like you have to do everything today. And don't feel like you have to do everything during residency. And this is kind of your like adulting. And so let's get into it. What's the current loan landscape? It's a dumpster fire. It just is. Um, uh, a lot of changes went through, and as they said in, Finding Nemo, just keep swimming. Um, it's going to be all right. And so what we have right now is the income-driven repayment applications are now open. Save Plan is on hold, which I know you're aware of. The Save borrowers with the $0 payments do not count for. I got muted.
That was me, sorry.
Sorry about that. We think that the new IBR and pay as you earn plans are available. At least last we checked. And then let's talk about like repayment plans in general. There are kind of two different categories. There are the fixed repayment plans and the income driven repayment plans. And I'm saying right now because as of June 6, 2025, this is what we know. We're in process of change right now with student loans. So the fixed repayment plans are available right now are the standard, which are fixed payments, 10 years. Graduated, again, over 10 years, lower payments in the start, higher payments toward the end, and then extended, which can go up to 25 years for fixed or graduated payments. And then the income driven repayment plans were old IBR, new IBR, pay as you earn, repay, which switched to save, and then ICR. Now, we don't know with the new plan that's going through government what the fixed repayment plans are going to look like and what the income driven repayment plans are going to look like with the changes. There's been talk that they're going to go to one standard, like one fixed repayment plan and one income driven repayment plan. But we don't know until everything settles out. The income driven repayment plans are all based on family size, your income. It has nothing to do with how large loans that you have. Like how much in student loan debt do you carry? It's all based on family size and how you file your taxes and your income. So there are types of different loan forgiveness, and this is where it gets kind of confusing because once the media takes hold of it, people get confused really quickly because ridiculous that you have an IDR plan, which is called the IBR plan, right? It's a subsection of it. So it's a lot of acronyms. Just kind of when you hear stuff in the news, sometimes it's hard to understand what they're exactly talking about. So there are kind of two types of loan forgiveness, two flavors. One is public service loan forgiveness. You have to be in an income-driven repayment plan. You work for a qualifying employer. You make 120 qualifying payments, which means you make a payment while you're with the qualifying employer. You file a employer certification form every year. You apply for PSLF forgiveness. The forgiveness event is tax-free, meaning in most places in the tax code, and Tyler is an enrolled agent, so he can speak better to this than I can. But when you have a loan forgiven, it is a taxable event. So let's say that I owe Tyler $10,000, and Tyler says, "You know what, Steiny, I'm going to write it off, and you don't have to pay me back." And I'm like, "Well, that's great." So then Tyler issues me a 1099 saying that he forgave me for $10,000. When I submit that to the IRS, it looks as if I had earned $10,000. So having a forgiveness event that is tax-free is huge. And I know physicians that had $150,000 of loans forgiven. And instead of having that added to their bill as if they earned an extra 150,000 that year, it was just done. So that's PSLF. The other one is income-driven repayment forgiveness. You're in an income-driven repayment plan. You pay on that loan for 20 or 25 years, depends on the income-driven repayment plan. You apply for forgiveness, and then the forgiveness is a taxable event. So when we work with clients who are going for income-driven repayment forgiveness, we have to kind of plan for that taxable event for the forgiveness. Now, there's been talk that the income-driven repayment forgiveness is going away. There are some very fancy feelings that people have about student loans being forgiven politically. There are some very, very fancy feelings about physicians having their loans forgiven. So just be mindful of that. And that's kind of the environment that we're in right now. So for the 120 qualifying payments for PSLF, you have to have an eligible payment or the equivalent plus full-time and qualifying employer at the time that the payment's made. That's how you determine the qualifying payments. Now, the current forbearance under SAVE are not counting toward eligible payments. During COVID, they did. So $0 payments were going in. They were all counting as qualifying payments. So what happens if you're in the SAVE plan right now? You paid on the loans before. You're now in SAVE forbearance. How do you get those dollars back? So what they currently have set up is called a payment buyback. So what that is you wait until you have 120 months of employment at the qualifying employer. You calculate what you should have been paying during this SAVE forbearance, and then you will pay that amount to the loan servicer to get PSLF. Now, this went out. People talked about it. Tyler, do you know of anyone that did the buyback yet? Or I've got some clients, but it's going to be a couple years before they attempt the buyback.
Mm-hmm. Yes. Yeah, the buyback provision has been successful in achieving PSLF. I've seen it myself. So,
Okay.
but yeah, I mean, I think people's main concern is is the buyback provision going to continue to exist? And we don't know the answer to that.
Right. And again, this is like what we know now as of June 6th, 2025. So the other thing that I hear of is had a client that said they're a med student, their spouse works, has a good paying job, and they filed their taxes as married filing jointly. And they kind of look at their student loans and they're like, oh gosh, I live in a community property state. I should have filed as married filing separately, have I just totally hosed myself for student loan payments? And if you remember, the income driven repayment plan is based on your income, your family size, right? And so that's how they do the calculation. So there are two ways that you can certify your income. One is through the IRS tax information on a tax return. And the other way is alternative documentation of income. Now, this is where you submit a pay stub and or official record showing your current income, like from your employer. The alternative documentation, why don't we just do the alternative documentation for interns, like right out of the gate? Wouldn't that be easier? The reason why we have people file their income tax is if you're single, more than likely, when you file your income taxes as a medical student, the way the taxes will sort out, you wouldn't have earned any income doing a family size and discretionary income calculation. You're going to have $0 payments. So that's why we kind of do the income tax information. The other reason why doing the income tax certification is helpful is they will automatically then go back and check your taxes every year. And if you miss recertifying your income on some of these plans, depending on the income driven repayment plan, if you miss that recertification, what they do is they take all the interest that you haven't paid, they put it on top of the principal. It's called capitalization. And now you're paying a much higher payment, and they put you into a standard repayment plan. So you absolutely have to watch the your recertification time. And by doing the IRS, giving them access to your tax return is an easier way to do that. Now, for the person who should have done married filing separately, for them, it might make sense to do alternative documentation of income, do the pay stubs. And so just because you filed one way and you should have filed another, that's okay. There are ways to kind of certify your income. This first year, if that were you, the first year your payments may be more expensive, but then you can change from alternative documentation of income to the IRS after you're, for your taxes for 2025, for your payments in 26. So a lot of confusion, like I'm in a standard repayment plan, what's going on? I'm stuck in the save. I applied for IDR months ago. And the poor person is like, oh, we got to pay back our loans. Like it's not even on their radar. So what are some things that we can do today? And kind of what should I do today? What should I do soon? And what should I do in the future? So some actionable advice. So what can you do today? Take a moment, download your student loan file. This is at studentaid.gov. You want to navigate to My Aid and download My Aid data. Now, this document, it's going to be very hard to read. It is just lines and lines of text. It's not going to make a lot of sense. But it is your official record for your student loan. So hold on to that record. Make sure that you change your email address at your student loan servicer and studentaid.gov, especially if it's at your medical school email address. Make sure they have one that you check regularly so you can keep up to date with everything. Keep copies of everything related to your loans. And then this is when you start thinking about, like, with my student loans, with the amount of loans that I have and my future salary, should I be aiming for PSLF or should I try and pay off my loans? Most people during residency, it makes sense to kind of default into the income driven repayment plan because, again, we want to keep your loan payments manageable. We want to give you some breathing room during residency. So those are the things you can do today. What should you do soon? go ahead and apply for PSLF, get in the system. Even if you don't plan on utilizing it, with all the talk of PSLF being dissolved, that is for new borrowers, the med students that are starting in the fall of 25. But the argument is go ahead and get yourself in the system in case PSLF goes away. Then you can at least say, oh, I'm already in the system. Because many times with federal programs like this, they'll grandfather people who are already in it. Submit your income certification form when you start residency. There's talk that PSLF won't be available for medical residents during training, which is deplorable, quite frankly. I can't even believe that they're suggesting it, but they are. But that should be for new borrowers. It shouldn't be for people who are currently in the system. So submit your employer certification form, apply for PSLF, and then once the income-driven repayment options are released, go ahead and calculate your payment and make plans for making that payment to kind of build it into your budget. Things to do in the future. Pay very close attention to the income recertification date. If you don't recertify, you maybe change the 10-year plan. And like under the IBR, that's where the interest capitalizes. So you want to stay ahead of that. Do the employment certification form every year. Download your NSLDS file, that one from studentaid.gov, at least annually, and save all the documentation. Every good anesthesiologist has a backup plan. Every great anesthesiologist has multiple backup plans. Like, what if the whole student loan system fails or you're having issues? Document everything. You can contact your federally elected representatives. If like the income driven repayment plan is such that you can't afford to pay it for whatever reason, then consider going on deferment, going on forbearance. The key is you've got to be able to pay your rent, buy food, get around, live life during residency. Maybe not live life really large, but at least live life. And so it's not the worst thing in the world to go on deferment or forbearance. It's not ideal, but under the circumstances that may be where you are, and maybe look at going in a extended repayment plan or refinance to private student loans. The concern that I have with, and Tyler and I are going to talk about this, refinancing to private loans, once you take money out of the federal system, you cannot go back. So I've met many residents who are like, oh, I'm going to do internal medicine. I'm going to do 3 years and I'm out. And then they fall in love with cardiology. And then they do 3 years of fellowship. And then they really fall in love with interventional cardiology and they do another year of interventional, sometimes 2. And then they look back and they're like, holy smokes, I'm 7, 8 years into paying as a resident. Maybe I should do PSLF. And you may say, well, I'm going to do private practice. The rules around PSLF and what counts are always changing. And so defaulting into PSLF until you know for sure that you want to leave is kind of the good way to go. You don't want to burn bridges through this. I am going to come off my screen now, and then let's, Tyler, do you want to talk about some of the questions that came in?
Yeah, for sure. Sounds good. Thanks a lot for doing that. That was great.
Yeah.
Yeah, no, we can go through the questions that some of you posed.
Okay. And you're answering them as we went. Okay.
Say again?
You were able to answer, sorry, as I mumble. You were able to answer some of those as we were going. So perfect.
Oh yeah, in the chat. Yeah.
Okay.
Yeah, these were great questions. Megan and Carter, thank you for that.
So what other, I mean, we had some questions that came in.
Well,
We don't
we
know
can.
for sure if the people are here. So, I mean, we can. Do you want to hit some of the big ones, Tyler?
Well, a very consistent question that I'm getting for those of you that are graduated medical school just now, I get is, should I consolidate now or should I wait? And even like your question, Carter, about applying later on, um, the rules, obviously everything's in flux, and so it can feel like, I want to apply and get the $0 payment for the first 12 months. I totally get that. It really is going to come down to what stresses you more. The idea
Mm.
that you would be making some selections now and then have to make them again if the plan that you pick disappears, and then having to figure out exactly how to get out of that middle ground, because that's kind of what's happened with like interns last year who consolidated and then tried to get in to save. They're in the most nebulous situation of them all because they weren't even put on the save forbearance. They were put in this processing forbearance that they had to keep renewing like every 60 days. And it's been very confusing. So, um, and so you have to weigh the possibility that by consolidating now and choosing, and like right now, for everyone who's all your existing loans are from July 1st, 2014 and into the present, I'm saying IBR still, because I know like the proposed legislation may change the IBR rate from 10% to 15%, which would make IBR a lot more expensive than pay. But the proposed legislation might also get rid of pay. So, like, because they're both somewhat on the chopping block, I'm generally saying if you're going to consolidate now, pick IBR, because it is a more grounded income driven repayment plan than pay.
Yeah.
And I mean, I don't know. There's a lot of this is speculation, so I don't like giving any dogmatic advice here because there's not like we can't say for certain how it's going to lay out like 3 months from now. And we don't want you all to like we don't want you to respond to any of our conversation today out of like fear or desperation. Like I think that there
Yeah.
is time to think here. Like and like the reason for I think the motivation behind not the motivation that tends to make most residents concerned about not consolidating is twofold. One, they're afraid they're going to miss out on the $0 payment. That like they'll like try to do it in September, like you mentioned, Carter, and like they'll say, well, no, you can't use last year's tax return. We want a pay stub. And based on the current rules, that's not a thing. But I can understand why you'd be like, what if they change the rules? Like, what if they say last year's tax return or a current pay stub, whichever is higher? Whichever income would be higher. Like we want both, and then you'd be on the hook for like 300-400 bucks a month, and that would not be great, right? That's the first reason. The second is concern that if you don't consolidate, you're delaying when your PSLF qualifying payments are starting, as in, October versus August. And I get that because you're talking about the savings of 3 months of payments as an attending 10 years from now, which could be seven, eight, $9,000 in forgiven debt that you would miss out on by delaying consolidation. But I don't put a lot of weight on that because even though like that's a ton of money for you all right now in terms of like, oh my goodness, that's a lot of debt to be forgiven. You want to make sure that your decision ability and your mind on what you're able to do and how much effort you're going to have to make over the course of the next 12 months to manage your loans is reasonable and is not going to hurt your health and is not going to damage your, um, it's not going to cause you to lose focus on your training. Because not like for most attendings, the difference between having $250,000 in debt forgiven versus $241,000 in debt forgiven is minuscule. It doesn't feel that way now, but for the most part, it's not really. You know what I'm saying?
Yeah. So two thoughts, Tyler, and you make up a great point. $10,000 is a lot of money, and it feels like a lot of money as a resident. And you don't want to feel like you're getting screwed, right? And some of the decisions that you make today, you won't know if it's the right decision till like 3 years from now. And that's okay. We're in such limbo right now that it can get, you almost get FOMO is like running rampant, right? Like, well, I heard this person got all this money forgiven. I want that much money forgiven. I need to do something right now. The challenge is like the IBR, they just put out they dissolved the Department of Education, which was managing the loans. Then they said, well, we're going to put it over to Small Business Loan Administration. The guy who was in charge of all this is now gone. It is a dumpster fire. And so keeping your head sane is important, because you will look back at your attending salary and your December pay stub. Many of you will pay more in taxes as an attending than you made as a resident. The dollars get bigger. And so, if you have to spend a little, spend money by not being in the exact perfect thing right now, that's okay. Thoughts, Tyler?
With one exception. One exception is the like the it's a fairly daunting difference on a resident salary whether your first year budget is going to have a $400 student loan payment or not, right? I think
Yeah.
that's probably the most relevant and understandable concern that is motivating many of you to try to, figure out what's best for you. And so, Jane and Tal and Carter and Brad, I see all your questions. We're gonna get to those next. So thank you for,
Yes.
for posting those. Um, the the rationale is that makes sense. And so I think that to the degree, because we can't sit here and say, oh no, 100%, you're going to be fine. You decide to consolidate in September once you know what the income driven repayment plans are. And then you decide you'll be able to use your 2024 tax return. We can't and should not promise that.
Yeah.
Even saying like, yeah, just, let your grace period run its course and just pick your IDR in October and start PSLF payments in mid-November. That's fine. Maybe it would be based on your pay stub and you're going to pay $300-400 a month based on that salary, whatever that is. With that potential risk in mind, to the degree that that cost during your first year would have a meaningful impact on your life, if it's the stronger that is, the more likely you should just proceed with the consolidation and within the consolidation application, pick IBR, or if you want to try pay. I don't have a strong aversion to pay. It's just if I had to pick one. And so, and to the point of your question, Tal, your follow-up question, because it's relevant to what I say. We keep saying words like consolidation, like it's saying sandwich, right? Yeah. Let's consolidation is a process that federal student loan borrowers are allowed to pursue, because you've got like a dozen or whatever loans, individual loans, when you log into studentaid.gov. You can, within your login there, you can apply for a consolidation, which essentially allows you to take all your loans and combine them, consolidate them into one federal loan. It's important to note that this is different from refinancing. That means taking it out of the federal program and with a private lender. We're not talking about that, and that is a very niche and unusual situation in which a resident would do that. Consolidation is within the federal loan system. What happens is when you apply for a consolidation, that application includes the question, do you want to do this consolidation right away and jump into a repayment plan? The reason why interns have often done this for the past several years is because they've realized that it opts them out of the 6-month grace period. The 6-month grace period is from when you graduate until 6 months later, and that's when repayment is required. And usually it sounds like, yeah, that's great. I don't have to make any payments for 6 months while I get myself settled. But knowing that last year, presumably most med students made no money, if you e-filed a tax return, you have proof of that $0 income. And in the application for consolidation and picking a repayment plan, you can say, hey, here's my proof of income, which is nothing, and I don't have to pay anything, because whether it's 10% or 15% of your discretionary income, both of those calculations on zero income is $0, right? And by doing that, rather than having public service loan forgiveness payments start November 15th or thereabouts, you can have them start upon completion of the consolidation application, which, if done immediately after graduating medical school, tends to be end of July, early August or so. So then you've got August, September, October, maybe November, 4 months of payments that count toward the 120 PSLF payments that Steiny was talking about, and you're getting ahead. So that is what consolidation is. Recertification, Tal, is, if we're talking, there's a couple of certification processes with student loans. One is income. Income certification or recertification is when your student loan servicer requires you to provide them with your income information. And that is, by default, your latest electronically filed tax return. If you don't have that, then they ask you to upload a recent pay stub. And this typically happens on an annual basis. I don't think that has been typical in years, though.
Yeah.
So income recertification, though, is something that a lot of people are like, when am I going to have to certify my income? That's basically when the loan servicer says, hey, send us your pay stubs, or upload or link your latest tax return to your application, and then we're going to update your payment amount based on that income, since so many people are on income-driven repayment plans. That is what certification is. And then I'll stop talking after this one, and you could jump in, Steiny. The other certification is employment certification, and that's when, with your employer through the PSLF help tool, also on studentaid.gov, you can you can facilitate proof that you are working full-time for a nonprofit organization while on an income-driven repayment plan. And your employer or someone in HR who's authorized to do so can certify and say, yep, Dr. So-and-so is working at this hospital for the past 12 months. And what that process normally does is it updates the number of PSLF qualifying payments that they have on their records. And that usually, you don't have to do that on a specific interval, but I generally recommend also doing that on an annual basis.
Yeah. Why don't we get to Dr. Jane's question?
Sounds good.
Second year pediatrics resident, 215 in student loans, been on Save, and she's in, Save forbearance, which at least the good thing with the Save forbearance, at least interest isn't accumulating. So it's not like you're in a taxi in traffic and the clock is just going, right? if people even know what that means anymore now with Uber. But she's asking, should I stay in forbearance and hope to buy it back later, or should I try and get into another income driven repayment plan? The
Right.
challenge that I think of is, I get it. You being in pediatrics, not knowing if you're going to do fellowship or not, um, going for PSLF seems like a reasonable thing to do. Somewhat of the challenge that I have with the question is, because we don't, this is the one time over like this past year that we just don't know what they're doing to student loans. So you've got a couple different options. One, stay where you are, hope to buy back the time later. If you can't buy it back later, then it's kind of lost months, and you just have to wrap your head around that's kind of part of paying the ticket to ride this crazy student loan ride that we're on right now. You could try and move to a different repayment plan. The challenge is the loan servicers are so overwhelmed right now. My thought is, what if you move to a different repayment plan and that one is eliminated, and now you've got to shift to another repayment plan? It depends on, from a mental load standpoint, like, are you going to be okay being shifted around back and forth as opposed to just staying where you are, waiting for things to settle, and then moving to whatever repayment plan? Because, for example, people in the repay plan, they were automatically shifted to save. No one asked them. They just shifted everybody from repay to save. It's possible they could do the same thing with the save plan. They're like, and if they go to one income driven repayment plan, which has been proposed, then they would shift everybody in whatever income driven repayment plan to the new one. What are your thoughts, Tyler, on trying to shift, trying to move in the middle of the train that is like rolling along?
So right now, there are tens of thousands of applications that are in the queue for income-driven repayment plan income-driven repayment plan applications. And there's and even like buyback provision applications. There's a really long queue for that too. And so that's another reason why I'm not strongly inclined to think that making a move is for the best. I don't think I should, that was a weird way of saying that. You should, I mean, I can see the merits of jumping into another plan, because then at least, because from the current rules, upon receipt of your application, when it's like in processing, even if it's not completed, say you change to IBR or pay, even if you're not officially in the plan, being that the moment that you're in process, you should be able to get payments counted retroactively on that plan, not having to use the buyback provision any further. So I can see the merits of considering doing that, because then you're cutting your losses on like these months where you would have to rely on the buyback provision continuing to exist. Let me give an example, Jane. If you are how do I okay, let's say you applied right now for IBR, and you get an email or a letter from your loan servicer sometime, around like July 1st to say, like, okay, yeah, we've received your application and it's in process, or like something on your loan servicer website acknowledges that your application has been received. From that point forward, like even if you're not officially on IBR until October, because it takes them so long to process it, theoretically, years later, you should be able to, when you do your employment certification to try to get PSLF payments counting, you should be able to make requests for payments to be qualified, not from October when you were actually approved, but from July when it went in process. So that is like a way to kind of shift and get away from the save forbearance question. So I can see the value of it from that perspective based on the current rules that we have now. On the other hand, if you were to apply for a plan, be mid-process, and then they get rid of that plan, I don't really know what to tell you right now.
Yeah.
We might have some new information, and seems like we're doing these webinars more frequently. I kind of like it. It's like nice to have good touch points on this. We'll talk about it as it becomes relevant and we have accurate information, but it just seems like I saw so many interns last year get caught in this processing forbearance debacle, and it was so stressful being in like this. They thought that they were doing the right thing by being proactive, and then they ended up being in this weird spot. And so that's why I also think that it's has merit to just stay put and to say, you know what? So far, everything that we've seen in the legislation is not touching the PSLF buyback provision. So I'm just going to stay put with the save plan forbearance and just see how it goes. So
The other concern that I have is in the federal student loan system, if something gets kicked back, the default is that they default you to the standard repayment plan. So my concern is, let's say you apply for a program, the program goes away, the servicer goes, okay, everybody in this program, you get kicked to the standard repayment plan. So now instead of $200 payments, now it's like $3,000 payments a month. So whenever that generates, and some of that isn't like, it's like set up in the system. So that could it happen? Maybe. I mean, that's kind of what happened with, I'm sure you saw in the news where people were paying at a certain payment. They were on an income driven repayment plan. They didn't recertify their income and they then defaulted to the standard. So it does make me have pause of trying to move again when the train's in motion. Are we going to get caught in a system that then is going to be more painful than just kind of having to do buyback? Or worst case scenario, if the buyback goes away, which I don't think it would, but let's say it did, then it's kind of an asymmetrical risk, if you will, of staying where you are, because at least we know what to expect with that. And I think during residency, holy smokes, I mean, you guys are having to deal with call schedules. And I mean, I remember even as an attending, my life revolved around call schedules and trying to make it to kids' activities and keep your life together is difficult when you're having to deal with a schedule. And then if you get kind of sideways with the student loans and then you're having to deal with that, it may not be worth the stress to do it. And when in life you will end up spending money in ways to reduce your stress, and more so when you become an attending, because you may not have the time. Like, oh, the sprinkler system's broken. I'm a physician. I can figure out how to do it. Yeah, I can, but is it worth it as an attending my time off to go and track down, the sprinkler head and fix the PVC pipe and do all the stuff? You may want to kind of look at student loans as the same way. You don't have time and you don't have money right now. Um, and so do you want to kind of take on that extra stress or stay where you are? That may be one way to think about it. And again, we don't know the right answer, and we may not know for years, right?
Yeah. Yeah. I mean, yeah, I mean, there's, yeah, there's not a 100% best move here. I can tell you that nobody, like when you're in really bad traffic and you get the idea that maybe like this other lane is like a little bit better, they all suck, right? All the lanes suck. If you're in a lane and it feels bad, you're not missing out. I don't know if that helps. I'm not trying to, yeah, and I'm not trying to make light of it. It's bad,
Yeah.
and stressful. I think, I think patience and waiting for more information is never a bad way of processing decisions. And like I and I it's not a foolproof plan. Things can happen, rules can change that we can't control now or know now. But patience and getting more information is wise for all of us. Um
Brad had a, do you want to tackle another one? Brad had
yeah,
a
yeah,
question,
yeah,
you
go ahead.
know, uh, does the advice of waiting to consolidate change if there were federal student loans from undergrad that immediately go back into repayment? Um, the so this makes me think of medicine, right? Philosophically, it's important to understand not only the what, the how, but more importantly, the why. Why do we have people consolidate in the past? In the past, we had resident or medical students consolidate their loans right out of med school so they could get to the $0 repayment plan. There is some benefit to not consolidating your loans in that, because your loans are at different amounts, they have different interest rates. If you don't consolidate your loans, you can actually target your loans when you're paying them back and say, if I've got a loan at 8% and one at 5%, I can target the one at 8% and pay it off faster to save me money in the interest, right? For because the undergrad are immediately starting back into repayment, it might. I'm trying to think if it is there any benefit to consolidating them. It may actually be, um, it may be worth it not to consolidate, because I feel like, are the rules going to change on payback of undergrad? Now it's interesting, under the SAFE plan, there was a different differential for undergrad versus graduate school loans for how much you had to, like, the payments on those. And you had to, it made it a little challenging. You had to go back when the loans were consolidated and figure that out. But I don't know what the system's going to look like with when you have undergrad and grad school loans.
Hmm.
Tyler, your thoughts?
I mean, so Brad, if you're going into repayment, let me just read your question. Yeah, okay. Um, yeah, if your federal loans from undergrad immediately go back into repayment after medical school graduation, and Carl, you said yours automatically got put into forbearance until the grace period. Um, that might be worth looking into, Brad, just to see if that happens. But I mean, in theory, if that doesn't happen for you, I mean, going into repayment, part of it depends on, well, okay. No, I think I do have for this. I think I've got to I think I would consolidate, because if your undergrad loans are going to go into repayment, then I mean, you could theoretically, kind of like what happened with Carl here, where they get put into, you could put it into deferment, which is essentially the same thing as the grace period, where interest is accruing and you're not getting PSLF qualifying payments. But if it's already kind of mid process and you'd have to do something anyway, it's like it's kind of forcing your hand, where it's like, well, I got to do something because my undergrad loans are going into repayment. So Brad, if your loans don't automatically get put into forbearance, then I think I would consolidate in that case, because you've got some loans that are in repayment on some income driven repayment plan. So you're already kind of out there and like at risk of like having to switch whatever payment plan the undergrad loans are on, right? So if you're going to be stuck with that potential risk of having to change things up again later, then um, you might as well put all of them in that situation, because this isn't about like how much debt is consolidated or not. This is about your time and the annoyance of managing this system. So, if you're already going to be in that situation, then I think that I would consolidate now.
So I think Dr. Eva, I'm going to assume that she is graduating from med school, and she's like, well, when should we apply for income driven repayment plans? And I guess that's something we haven't addressed, like the graduating medical students. Gosh, I was hoping that when we did this webinar, we'd have some clear direction as to how to engage the student loans.
Mm-hmm.
You can apply for income-based repayment or income-driven repayment plans. Now they've opened it up, but like Tyler said, they did an audit, and there's only like 3% of the consolidations have been processed. I think, when you're in the grace period, if you have unsubsidized loans, you are still accumulating interest on those loans during the grace period. When you find out, it seems reasonable that at some point you're going to be in an income driven repayment plan as a resident just to afford the payments, whether you're going for PSLF or eventually you're going to pay them off. It may be worth to consolidate. Well, it depends. If you're thinking about paying off the loans soon after graduation, like soon after residency, like you've got 50,000 or 75,000 or something like that, it may be worth it to just hang through the grace period, keep the loans separate, and then you can tackle them one by one, which is helpful. It gives you options. If you're thinking you're going to go for PSLF, then applying for the IDR and applying for a plan now could make sense. Because then it would stop the interest from accumulating once the $0 payments go in. It's tough though, because we don't know when they're going to process this stuff. I mean, before reliably we could have people consolidate after medical school, and it takes med school a little bit of time to let the loan servicers know that you've graduated and now you are able to do consolidations. I mean, it's part of this is going to be keeping in the loop with your servicer and finding out, like, okay, income driven is available. Let me go ahead and apply for it, and then you'll have to watch and see, like, when stuff gets processed and things.
Yeah.
Um,
Yeah, well, we're gonna have to. We will definitely be having another one of these. I'm not even gonna set a date yet because, like, why should I bother, right? We're gonna find out when we know what we need to know. I'd say, I don't know, maybe September, because I believe that Congress needs to have the law said and done by the end of September in order for it to pass during this session. And in conjunction with this student loan stuff is the larger income tax bill, which is meant to extend a lot of the tax benefits that high income earners and business owners benefit from. If they don't pass the law this year, then those benefits expire and rates for high income earners and business owners will go up in 2026. And that's just not going to happen. They're not going to let that happen. So I think that they will be forced to make a decision by the end of September. And so we'll have to have another session like this to be able to follow up on these unknowns.
Yeah.
Yeah.
Other questions?
Well, one thing,
one other questions, and two, has this been helpful for you all? I wish we had more answers than we did questions for what to do, but just realize too that it's going to be okay, as stressful as it feels. And I know I'm not there, but I can imagine how stressful it is. I remember what it's like to be a resident, and, like, I had my son on the way, and I knew that I had to moonlight to be able to afford my wife coming home to be with my son. And so I was a moonlighting freaking machine to make the cheese so that we could do that. So those days, even though they were, holy smokes, not quite 20 years ago, but close to it. I remember those days. It was 17 years ago. So,
looks like we do have another question from Austin, that we can address. I wanted to tell you all too that, I think Michael Relvis, who was talking about disability, I think he's just taking care of a variety of office stuff, but he was able to just stay in the breakout room. So if you were staying here to hear student loan stuff and you had your question answered, but you have a question for him, you can just go over there and ask him. Just so you know, he's there until 2, and we're here until 2 p.m. Eastern time as well. Let's see. Okay, so Austin wrote, "Thank you guys for all the advice and information. You're very welcome, Austin. I appreciate that. I'm an incoming intern, married, filing jointly last year. Correct me if I'm wrong, but at this point, at least regarding this year's payments, there's no way to modify this, and we'll have payments based off my wife's income from last year. From what I understand, moving forward, is it smart to file jointly to get a higher deduction for marriage?"
well, I guess, Austin, if you want to direct message either Tyler and I, are they able to do that, Tyler? And
I think they can. I think
because kind of what the reason. So I guess let's take a step back. why do you do married filing jointly, married filing separately? When you do married filing jointly, they look at the combined income to determine your income-driven repayment plan and your family size, and that's how they calculate it. The reason why it makes sense for some people to do married filing separately is if your spouse's income is like over $100,000 and you or let's say it's $200,000, let's go big, or 250,000, and now your payments are like huge. If you do married filing separately, you can then just look at your income only. And if you're in a community property state, when you file your taxes, married filing separately, you can take the total income and divide it by like exactly in half. And so there's a little bit of maneuvering as far as doing that. And for like Austin, for this year, depending on what your wife's income was, it may make sense for you to just do that alternative. What's the name of it? The alternative documentation of income, which is going to be your pay stub this year. And then you'll have to look at next year when you have your wife's income plus half of your income from your intern year. It may make sense to do married filing separately, depending on which state you're in, and also taking into account like missing out on some of the tax benefits of married filing jointly. And it's really easy to let the student loan tail wag the dog when it comes to some of this stuff. And people are like, oh, you should, much like medicine, there's very rarely, you should always do this or that with student loans. You have to kind of have the numbers run to make sure it makes sense. Smarter filing jointly to get a higher deduction for married filing on top of using the deduct. Exactly. Yeah. So you've got to kind of run the numbers, and also it depends on the community property state, whether that, whether that reduces the payment enough that it makes sense for you. And because if your payment is less than the interest will accumulate on those loans. Now, it won't capitalize, but it will accumulate. And so if you're looking at in the future paying it off without doing PSLF, then that may not be as helpful, if that makes sense.
So yeah, Austin, so one thing about there's an interesting thing from the like tax filing regulations. You can file separately and then amend the return to filing jointly. You cannot file jointly and then amend to filing separately. So you can't modify it for that reason. There are some provisions where you can go the other direction, though, and some have taken the stand that it's okay for them to file separately to get a lower student loan payment, but then they would have saved more on taxes if they had filed jointly. So then after they certify their income, they will go back to the IRS and amend their return and file jointly to get a bigger refund back. I would be really careful about this strategy. There are some student loan advisors that have advocated for this, and I think that I think that it is I think it's unwise to take that position. I don't think you're suggesting that, but in case you come across that advice, I'd be really careful because it seems like a lot of people have gotten away with stuff within like student loan income recertification that, where it didn't really matter. it kind of feels like more of the minutia is going to matter now, and that
Mm.
when it comes to getting money out of the government, that there's gonna it I don't know, it feels like it could be putting yourself in a precarious position.
Yeah. I,
Um,
I agree. I mean, there were some planners that were suggesting that like people attendings put the entire 401k contribution in 1 month so that their pay stub showed a very low income
oh
and
yeah,
submit that. Um, that is, in my opinion, I'm not a lawyer, I'm not a tax preparer, but that feels like fraud. And I
that
would
is
just
100% not okay.
it not okay.
I am a tax professional, and I'll tell you.
Yeah. So,
Yeah.
and to Tyler's point, there are people that say, oh, you do married filing jointly, you get it certified, then you do married filing or married filing separately. You can do married filing separately and amend a return to jointly. You can't do jointly and then amend it to separately. And so the other thing you got to ask yourself is, I get it, you want to reduce your loan payments, but you're also going to have to pay somebody to help you file married filing separately and then amend the return to married filing jointly. And then you have this amended, do you, in the grand scheme of things, is it worth it to you to do that? And maybe it is, but I feel like there is, because you're a physician and because it deals with student loans and forgiveness, I feel like they've already zeroed in and said, oh yeah, doctors and dentists were talking about getting away with PSLF during the time that you're in residency training. I mean, we already have a target on ourselves. I, don't, I would be cautious about poking the bear.
Yeah.
Even if it potentially saves you some money. But that's me.
I'm going to share some information with you all in the chat here. Somewhat relevant to your question, Austin. And also wanted to make sure that you get access to a few things, just generally speaking. We're gonna be signing off in about 10 minutes. So I want to make sure I get this out before that happens. If you are looking for a tax preparer who can help with these situations, I highly recommend you contact Adam Markowitz. Adam Markowitz is an enrolled agent, and I'm going to put his website in the chat here. I do not have any conflict of interest with Adam.
So Tyler, what's an enrolled agent?
Oh, good question. An enrolled agent is a tax professional designation similar to a CPA, but different education requirements and different continuing education requirements. There's a lot more CPAs than there are EAs, but and CPAs definitely require more education. But a lot of times CPAs, they venture into different parts of tax advice and management. Enrolled agents are almost exclusively for what's called tax filing and compliance. And compliance is like helping consumers to be compliant with the tax code in filing their taxes. So I'm an enrolled agent. I don't file taxes because as a financial planner, it totally destroys my spring if I try to do tax filing and financial planning. But I do have the designation because tax advice is key to financial planning. And so that's why I got it. But Adam is also an enrolled agent, and he primarily focuses on tax filing. So he does great with that. And he's also a certified student loan planner. So he's got what you have, Steiny. So he's
Yeah.
able to give advice like surrounding the student loan situation too, and help you file your taxes. So he's a great
Yeah.
person to know. Let's see. Another one is okay. Now this I do have COI, conflict of interest. Michael Relvis, he's a sponsor for our Physician Sense podcast. Which if any of you have not been listening to our Physician Sense podcast, you have to give it a try. Me and Chad Chubb, he's another financial planner. Oh, Adriana, thank you. That's so nice of you to say. I'm glad you like it. We love talking about all the things that we've done so far. It's a really great conversation to have with Chad, and we're actually recording again in a couple weeks, so I'm looking forward to that. Um, so listen to the podcast, the Physician Sense. I just put that in the website. But anyway, Michael Relvis, I put his website in there too. So if you wanted to see what sort of rates you could get, GSI or otherwise, as he was talking about, you can visit him. But he is a paid sponsor of Physician Sense. So just so you know, I have that COI. And then,
I
yeah, go
I
ahead.
don't have a conflict of interest with Michael Rovis. He's on my short list. When
Ah,
people say, "Hey, I'm looking for," I've got disability policy. The clients that I come through that already have one in place, I recommend that he reviews it to make sure it's what it should be. Completely comfortable sending people his way. He does a really great job at looking at policies, reviewing them, kind of finding the good, the bad, the ugly with them, and very, very comfortable with the work that he does.
yeah. Yeah. I've known him for years and he's very thorough. And boy, is he, yeah, he just has his head in the physician disability insurance space. And you can tell when you talk to him. Let's see. And then there's just one last thing. I wanted to um put in my standard resident financial plan checklist. That's what that PDF is that I just put there, that I put in the chat there. So you can download that. It's a great starting point for not just student loans and insurance stuff, but other things too, because we know you got a lot. And then I have no conflict of interest, but second opinion financial planning. Looking for a financial planner, Steiny does great work, and he can really relate to you because he is one of you. So, if you're looking for financial planning services, make sure to check Jeff out.
Thanks,
Um,
Tyler.
did any of you all had any have any other questions that you wanted to discuss? Let's see. I'm gonna put Jeff's website in the chat here too.
No,
Here you go.
well, thank you, sir.
Yeah. Yeah. All right. Well, okay. Well, then I think we'll sign off then. It was really great having you. I'm going to leave the room open because Michael and Jane are talking right now. And so I'll leave things going. I'm going to leave the room open, but the formal time of our discussion is over. So Austin and Adriana, for you're still here. Thanks for joining us. And we'll talk soon.
Thanks for putting this on, Tyler.
Yeah.
And thank you all for coming.
Yeah. I think I'm actually gonna pop over there and see what they're talking about because I'm always
Yeah,
interested in learning what Michael has to say.
I'll see you over there. Thank you all for coming.
Looks like all the attendees are gone.
Okay. I tried to go over there and say bye to Michael. I guess he was still, I guess the room closed down.
You got me. I don't know.
Let me see if I can
Well, still
join.
says there are breakout rooms in progress, but it looks like it's.
Did Michael wrap up, Tyler?
I think he's here.
Oh, there he is.
Yeah.
There it is. Well, since I got you all, great. We can do a quick debrief of the recording process.
Ronnie, just so you know, I've got a meeting with Michael in 2 minutes and we're gonna have to
No
go.
problem. This is it'll just take a second.
Okay.
I have already uploaded the results. It's about 10 gig worth of files uploaded to Tyler to our Google Drive.
Okay.
There is a folder in the projects. There's a subfolder in the projects for video recordings, and there's one for that's dated and labeled this webinar. There's audio only files, so if you wanted those for podcast purposes and things like that. And then there are video files that have video and audio with them. There are files that have video that have just what you shared, your slides and stuff. You'll see those labeled as sharing video with the sharing word in them in the title. And then some of the really long video got broken into 2 files just because they were so large. So Tyler, if you wanted to share a link to that folder with Steiny and Michael, then they could just download the files that they want from our Google Drive at any time and chop them up. Do whatever you want to with them. Download them and do whatever you want to with them from that point.
Okay.
So that's just wanted to share that. And
Do you guys want that?
Sure. I mean, I don't, it'd be interesting to kind of take a look at it.
Michael?
Oh yeah, Michael, you're on mute.
I was like, wait a second. Yeah, I would also want to at least see it. So maybe like, is there a way to access it to see the recording without having to download it right away?
I mean, you might be able to play it from the Google Drive and it would stream from the Google Drive. That I don't know.
Probably, right? Okay. Yeah. So if you don't mind, Tyler, I'd appreciate you sharing it. I can't actually download anything from Google Drive. My computer, like for compliance purposes, doesn't like Google, but I'll look at it first. And if I actually think it was good enough, like, I mean, I don't know, you go into this thing thinking you're going to be great. And then like, if I actually see it, I'm like, wow, that really sucked. Then maybe I won't take it. But assuming that I don't think that, then I'll bug you guys to figure out how to get it, if that's okay. But for now, just go ahead and send the link and I can view it and see what I think.
Yeah.
Okay. Ronnie, since you're in it, can you just email both of them the link?
I don't know that I have both of their email addresses, but I can try. Hang on just a second. Let me get to it.
I'm sure you've at least got mine.
I messaged Larry.
Oh, yeah.
Okay, cool. Yeah, I can text him real quick too, and it's not a big deal.
Okay.
Let's see.
Ronnie, I just threw mine in there.
Okay, hang on just a second. secondopinionfp@gmail.com.
That's a sign of a good businessman in startup mode.
Yeah, it's interesting. I've got a Jeff at secondopinion.com, but I put a lot of stuff to that generic one, and then that way I don't have like when a client email comes in, I see it right away because there's not a lot hitting that email, which is kind of nice. And I just went to SaneBox, and I'm playing with that so to have it automate instead of having thousands of emails in the inbox. I've got very few that actually hit it, which is nice. I'm playing with it. We'll see.
Cool. Yeah. All right. Well, can
All
we
right.
can we go, Ronnie?
Dude,
Well,
He's
how,
like-
how utterly disrespectful. Yes. Feel free. I'm sending this stuff out. I found the mechanism for that. And you should be able to get those here in just a few minutes.
Okay, perfect. Great seeing everybody, and
You
thanks
guys
for
too.
coming by.
Yeah.
Perfect.
Thanks for coming,
Donnie.
guys.
All right,
See
take
you
care, guys.
Bye.
Bye.